There are various ways in which investors can create wealth using equity. They can buy shares in the secondary market, they can invest in mutual funds, they can also buy shares that are coming out for the first time in the primary market. And that route is called IPO investing. Initial public offering is what IPO means. And that's what we're going to talk about today. Over the last 3 years, ever since COVID came, the primary market, that is the number of companies that are coming out with a public issue to get themselves listed in the stock market, has been on the rise. In fact, the stock market had a record number of IPOs in 2022 and 23. Now that's a trend that's going to keep happening going forward as well. But how is IPO investing adding to your wealth? Are you able to use that as a means to create wealth for yourself? That's what we're going to talk about a little bit more in detail. But first up, let's look at what is the process of investing in shares through IPO. IPO, as I mentioned earlier, is looking at investing into companies that are coming for the first time into the stock market. They are looking at either raising capital for themselves, or it's also called an offer for sale, which means somebody who is already invested in the company is coming out to exit and you are buying shares from them. So any of these options are open. Now these companies come out with a limited period of time. Usually the time period is about 5 days to max of 6 days. Now these companies have to register with the SEBI, a Red Herring Prospectus, with all their complete details before they can come out with a public issue. As an investor, these are the steps that one needs to do to apply for an IPO. First up, you're expected to go onto the website either of SEBI or the company and then download the Red Herring Prospectus that is approved by SEBI. Now this Red Herring Prospectus gives you in-depth information, financial, non-financial and all other crucial information that's important for you to make a decision whether the company is worth investing or not. So this Red Herring Prospectus is the first place for you to visit to make your decision. Next up, you need to ensure that you have a Demat account that's live and is working. Third, you need to go on to the website, either your Demat, your bank or the website of the company, and then register your claim to apply during the application period. Usually as a retail investor, your max ticket size for investment is 2 lakhs. So if the company has a price of say 150 rupees, then you will need to apply for that many lots as the company prescribes, so that the total value of your investment is not above 2 lakhs. So that's very, very important. Next up, all these investments, you don't write a check or you don't transfer money. You merely follow what is called an ASBA model. The ASBA stands for Application Supported by Blocked Amount. What it really means is, by applying through ASBA, the money never moves out of your account. It's actually blocked within your account itself. So the money will continue to remain in your account, but temporarily is blocked for this particular IPO. Now, after the issue closes and say 5 days hence, when the allotment process is completed, either the amount of shares allotted to you gets debited from this ASBA, or the ASBA is removed so that you can use the money in the way you want. So ASBA is a beautiful system where money doesn't leave your account, go out and then come back. It only gets out if you are allotted shares. And the allotted shares then gets reflected in your Demat account. This is the complete process of an IPO application. Now once you apply for it, then you wait for the listing date, and every IPO that gets listed after allotment has to get listed either in the BSE or the NSE, and then you're at a liberty to sell the stock if you want. Now if you sell it within 365 days, obviously you have short-term capital gain. The amount that you have gained will be subject to tax at the highest rate of your tax. If you wait for 365 days from the date of allotment, then it is considered as long term, and therefore the taxation is only 10%. So this is the differential between short and long. So obviously, if you are somebody who has a long-term perspective, then it's good to kind of stay invested for beyond a year. Now, some of the do's and don'ts about investing in IPOs. First, I'm going to talk about the don'ts. IPOs are like marketing vehicles, right? The IPO company comes out with a lot of ads. It's very shiny and bright, and there's a lot of hype around that company. Don't be fooled by it. Do your own analysis, do the homework, and go by hard facts that you know of that company. Extremely important that you do your due diligence. Second, ensure that you have a certain amount that is budgeted for these IPOs and you remain within it. There are lots of people out there who offer margin funding for IPOs. So they give you additional credit with the hope that you get a larger allotment, and a lot of that doesn't pan out the way it is supposed to. So stay away from greed. What you need to invest, budget that amount and work within that amount. Third, don't look at quick money in a big way. IPOs are meant to give you an early leg into the company. They are not meant for satisfying all your greed. So don't look at big money to be made in the short term. Now, what are the do's? Understand that IPO is one more way of investing. It's not the only way. So stay away from FOMO, fear of missing out. A lot of people I see lose money because they went through this process of, I shouldn't be somebody who didn't apply for this IPO, right? And got caught with this. After the IPO, allotment happens and you're allotted shares. If for some reason the stock is good, but it lists at a lesser price, then use that opportunity to double down on that investment, which means make a little bit more in that same stock, buy something more. As long as you're convinced it's a great company, you need to kind of double down on that investment, make some more investment into that. Third, ideally look at long term. It's important to hold these investments till the companies mature at a point and then they kind of give you better returns. Don't always look at listing gains. That is, the moment it is listed, you go sell, you make a certain gains. More than listing gains, look at long-term gains if you think that company can support it. These are two ways of not doing and doing stuff which can be beneficial for you. But how do smart investors make their monies on IPOs? Like I mentioned, first up, they don't go by hearsay, rumor, tip, or stuff. They do their homework. Read the Red Herring Prospectus. SEBI demands a whole lot of information from these companies, and a lot of those information is available in the Red Herring Prospectus. It gives you such a detailed analysis. Of course, you need to invest your time and energy to read it. Second, always understand that not all great companies are shining. Classic example is Infosys. When Infosys came out with an IPO, the issue was undersubscribed and the shares was listed less than the offer price. So there could be an Infosys right there, but you may not be seeing because you're observing something that's more shiny. So look for something that has great value that is not as shiny. That's where the gain will come from. Third, look at long term. Look at the big picture of things. And I'm sure that you will get your options right. Last but not the least, I'd say is allocate a certain portion of your investing into IPOs. You may have 10 different buckets. You may have some bucket for mutual funds, some for fixed deposits, so on. So create a certain bucket for IPOs and invest within that means. Always good to have a budget with which you're going to operate on IPOs. If you did all this, I'm sure you will have winners. Let me also tell you, there have been both winners and losers. The last 3-4 years, you had some big losers. For example, Paytm as a stock has gone through a tremendous amount of value erosion for investors. Of course, Paytm as a brand is very well known. People love the brand, but brand is something, financial performance, especially stock market performance, is completely different thing. So be very wary of believing that every brand that you see is out there to create wealth for you. Not necessarily so. On the other hand, there have been some very unknown brands which have created tremendous wealth for you. So look at both and take a very conscious decision. It's always good to be a very, very sober investor than try and get a very large and a greedy return in IPO.